insinuations being made by Muddy Waters aren't necessarily accurate. It all has to do with credit conditions. Anyway, let's bring in Robert Schein from Blanke Schein Wealth Management. Rob, thanks so much as always for joining us. Just firstly, we're pretty much stuck in a holding pattern when it comes to the S&P. We've got these wide dispersions on, I suppose, market expectations at the very least. Are you more in the five-handle camp at the end of 24, or are you more in the low four-handle camp?
Well, we're seeing, obviously, that trend is going to continue on the 10-year. It's trending towards, the five-handle, the 499. It remains to be seen. There's a lot of support there, so we could see that reverse. But we're looking at obviously watching the 10-year very closely, because that's been the show. I mean, that's where we saw a lot of the equity gains over the month of November. And now I think we're seeing an exhaustion play out, sort of an overbought sort of equity market, sort of consolidation right now, simply because you saw about 8.5% in the month of November, which is the longest we've seen in about 4 decades.
Yeah, but how does this set things up for 2024 in terms of more upside for the markets, given where the VIX is right now, Robert?
Yeah, VIX is not showing us anything. I think that's the major concern moving forward, which is when the VIX is sort of, lulling everyone to sleep and saying everything's okay, that's kind of when you want to be cautiously optimistic and keep your eyes open, both of them, simply because we know that the economy is slowing here in the U.S. We know that the Federal Reserve is on pause. They're not pivoted. They're not going to cut. Maybe the market, by way of the 10-year or even the bond market, is trying to suggest something's bigger is on the horizon. And so that's why you want to keep an eye open and some dry powder moving into 2024. But there are areas of the market that are working, and if you look at the 6 month moving forward, when the Federal Reserve pushes pause, okay, and they hold, the equity market moving forward in the last sort of 6 iterations of that have increased by 9%. Well, we just kind of saw that in the month of November. So that's why we have to be cautious. If they basically start cutting, the market then is only up 1.4% over the next 6 months. So we could be in sort of the same a range between those two, we believe.
Yeah, and I agree with you on that front. It almost seems like the market is rallying in anticipation of rate cuts. And when they do come by, it's pretty much, buy the news and sell the fact. I do want to get your sense on how you're timing the rate cut decision.
Well, if you look at futures markets over the last 3 or 4 weeks, it's changed, 3 or 4 times, right? So it was the midsummer of 2024 is where the betting odds are. And then it started moving up all the way through the first quarter of 2024. The reality is that the Fed has to keep rates higher for longer, as long as they can, because the first wave of inflation is now coming down. They're just waiting for, what we're seeing, the signs in the labor market starting to show some signs of relief, which is welcome. They're also seeing also housing, right? Housing is a big component of that. And those are the 2 last shoes to drop. Now, those are big markets, and that's a lot of momentum. So if they start, sort of turning over in a big way, the Fed might have to then jump into, okay, let's cut sooner than they actually wanted to. But we all know that 87% of the time, inflation historically comes in 2 waves. So we have to be cautious. The Fed has to be cautious. Even though this first wave of inflation is through, that doesn't mean that, okay, now prices come down. It sparks another sort of supply and demand issue where people start buying again.
I suppose it'd be a good thing if inflation came in that wave of 2, because that would perhaps better justify some of the analyst expectations when it does come to market performance, because I'm struggling to find a rationale where you have the Fed cutting, because that's obviously got some kind of, rationale for doing so, and that would be the economy is in trouble. If inflation's coming down, your earnings profile is in trouble because you're not bringing in as much money, and then you've got a situation for the economy is slowing down, so people aren't buying things, which is so much of the US economy. So how do you get market performance in those conditions, even if you do have, yields coming off on the back of all of that as well?
Again, it's much like you saw play out in 2023. We're going to see play out in 2024. it's a stock picker's market. You can't be broadly exposed. Obviously, we want to see sectors start participating, think healthcare, think financials. But within those sectors, you're still going to want to pick individual names, much like even within tech this year, right? There's the Magnificent Seven that have basically stole the show for their own reason. Obviously, it's AI. But we believe it's still going to be, you are going to have to manage very, with a rifle, not with a shotgun, as you build a portfolio and as investors think to 2024.
I do want to understand from you how you're looking at international equities at this point in time, Robert. Do you think that it's going to be about the U.S. As a defensive bet, given the uncertainty next year, and a busy political calendar, election calendar?
International comes into play. Obviously, we pay attention to what the dollar is doing. And as the dollar trades down, international looks a lot more attractive. But we also can't, discount the fact that a lot of the global economies are slowing even quicker and faster than the U.S., i.e., inflation's coming down faster. Therefore, we have to see what the net impact is to their economies. Again, there are some great opportunities internationally. And again, if the dollar continues to fall, you also want to look at emerging markets as well, because they'll catch a bid and they look attractive when the U.S. dollar falls. So, there's pick and choose your spots. This is going to be 2024. Start broadening your exposure to different asset classes and different markets, like the international market as well, as you're pointing out.
Yeah, but the dollar has been very steady and very resilient and very strong despite the naysayers. Robert, stay on with us. We'll dive a little bit more into your stock-specific ideas when we come back after this very short break. Robert Schein, C.I.O. at Blanke Schein Wealth Management, is still with us. Robert, let's talk about some of your ideas, and I do want to particularly talk about Eli Lilly at this point in time. How are you looking at the pharmaceutical sector? Because there's just so much focus on the Mag 7. There's just so much focus on the technology space that in an uncertain economic environment, you forget that the classic defensives hold in the likes of some of the banks, some of the financial, but more importantly, pharma names. Healthcare.
Yeah, we're seeing that. We've added this to our client portfolio. Even though healthcare hasn't outperformed this year relative to other sectors like technology, healthcare is important because it's value versus your growth, as well as the dividends and the income they can provide in client portfolios. So we like that sector. But in that sector, you want to look to companies like Eli Lilly. They're producing Mounjaro, which is that weight loss / diabetes drug, and that total addressable market is huge. Right now, today, if you look at that, just the market itself, it's about $5 to $6 billion. By 2030, that's going to be over $100 billion marketplace. Now, get this: that $100 billion is just calculated on the United States. Just the United States, and 70% of that is the United States market. So that's about 132 million Americans that could actually, jump on this train. And now a lot of the insurance companies are going to look at this because there's a 20% reduction in your heart attacks, your heart disease, and your strokes. So if the insurance companies pile on, it's not uncommon that this stock could double in the next few years from where it is today, simply because of the high demand.
It's just going to be interesting whether or not, in terms of patents, in terms of everything else, because what you're selling is indeed a very, very big story that could potentially be astronomical, considering everything that you are mentioning. But I want to jump over from Eli Lilly. Normally I'd want to stick there, but just in terms of Amazon, because, we've got a lot of chatter right now about, the rise of Temu and, Amazon cutting its fees. We found out about that this morning for some of their big sellers, but also what Schein is going to potentially do in the market, whether or not they're ever going to be allowed to IPO. Do you think that Amazon's going to let these Chinese competitors just, start to cannibalize their market share?
Yeah, it's funny you bring in Amazon, and Schein is close to Schein, and every time we see it, you always get confused. I have 3 daughters in my household, and so we've seen that, several times delivered at the front door. I will tell you, they're 2 different marketplaces. If you're familiar with Schein, and it's a great business, you're going to get a bag of stuff for about $100, and you wear them once and we're done with them. At least that's as far as what my daughters tell me, so they can re-up, right? Amazon is got everything else. So I don't think they're a competitor to each other. per se, but Amazon, keep in mind, if you look at Amazon as a business specifically, their operating cash flow this year has basically doubled. And for next year, it's continued simply because it's a multi-year turnaround story. So their margins and their profits are now on the right trajectory. The last few years, they haven't done anything. This year, they've done a turnaround story, as we're seeing reflected in the stock. And then you add in the AI story, with the partnership with NVIDIA and having their first, H200 supply chip partnership, and say that's 4 times faster than anything else in the marketplace. They're in the AI space, in the arms race. So yeah, I don't think they have to worry about a sort of competitor like Schein. If they just stick to their knitting and continue down the path, they're going to be doing just fine.
In the Mag 7, you of course like Microsoft, but I do want to get your thoughts in on Apple crossing $3 trillion despite demand concerns.
Yeah, Apple and Microsoft are 2 phenomenal businesses at the end of the day. At the end of the day, everyone's talking about, valuation. And we still have the sales. We still have the gross margins. Those are the A students that continue to get A's in class. And everyone's kind of saying, well, how come they're continuing to get A's in class? Well, if you look at the business model like Microsoft, right? It's the strongest that we've seen in quarters, right? Their subscription-based model, which who doesn't love that? Wall Street loves that because it's sustainable. It's a cash flow model. It's definitely consistent. It's a clean business. They're printing money. And now money that they have on the balance sheets is actually now earning something, which is even more. And they're, Microsoft specifically has about 70% gross margins, and they're going to continue using that leverage. Again, integrating AI as well. So, everyone doesn't like the A students, but the A students just got turbo jetpack on in their backpack, which is AI. So I don't know what to tell you, but if you don't own them, I don't know who doesn't. It's time to think about that. If you own them and they've done well for you, it might be time to trim and then rebalance to maybe an Eli Lilly or even a sector that you don't have exposure to.
Or just ride the wave. What's bad in following the trend if the trend is on your side?
We like that, but we like to sell into the strength. We like to sell when stuff goes up, right? And then we like to buy stuff when stuff is on sale or undervalued at a discount. And, and then also diversify. We round out your portfolio with things like gold and some precious metals, because if that second wave of inflation, inflation does hit, at least you're now bringing in a non-correlated asset class to round out your portfolio.
Robert, really quickly, just to steal some of your puns, is there any chance in your mind that the Mag 7 gets sent to the principal's office in 2024? Because obviously I would assume that you'd see that as a buying opportunity, but just how you're looking at it.
Yeah, there's always that unforeseen risk that also is going to take the Federal Reserve off guard, if you will. It's nothing that anyone's seeing right now. And so all of a sudden, everything's going well, and then something hits the economy, a geopolitical risk, who knows, and it has a net impact. Now, on these, I believe it'll be a buying opportunity, so have some powder dry, again, to take another bite at the apple, if you will, when those stocks do pull back, as we're using puns today. But the reality is that, you always want to be proactive, not reactive in markets like today and just about every day. So that's what we do for our clients.
Good advice. Thanks very much, Robert, for stopping by. Okay, we still got time. I think, before Robert, you go, I think we have about a couple of minutes still. So I just wanted to get your quick thoughts on asset allocation. We didn't touch upon fixed income and whether or not you think that adequate allocation to that is prudent in the coming year, given where yields are right now and where they're expected to be in the coming year.
Yeah, for the first time in a long time, fixed income is sexy again. So we're seeing some yields. And the good news about the fixed income market, if you look underneath the hood, sort of the lower credit qualities as it relates to sort of the overall economic environment, the double Bs in the corporate environment aren't blowing out, meaning they're not they're still intact. So that doesn't show or indicate to us that there's trouble ahead. And that's sort of the fixed income is the marketplace or the market that we want to see first if there's trouble, ahead in terms of a recession or something bigger on the horizon. So just a little bit of look of the fixed income market right there. But as an overall, let's say 40 asset allocation, it's not bad to take that 40% equity or fixed income that we've done, and we put basically 10% in alternative investments. Think like, say, gold or some non-correlated asset classes inside to round out the asset allocation, simply because we want to, even though the VIX says there's no volatility today, we believe there's going to be a lot of volatility for 2024. So what will help in that balance, stocks to bonds, are the alternative investments. Alternatives will sort of it's lightening the blow, if you will, of volatility if it's done properly and sort of put together in a nice, balanced, and diversified manner.
Very sage advice, Robert. We are going to have to leave it there. Thank you so much, though, for your time. Appreciate it. As always, look forward to speaking to you again soon. That was Robert Schein from Blanke Schein Wealth Management.